The chains of habit are too light to be felt until they are too heavy to be broken. What makes a great financial mind? Not a few successful deals, not a superior index, and certainly not a well-timed prophecy. So what is it? What makes one person among millions of people with access to the same facts, the same data, the same market see what others miss? And if the difference doesn't come from the information, could it come from how we look at that information, from the cognitive structures we carry in our heads every time we open a financial report, every time we listen to market news, every time we make a decision, with money being just the outer shell? This book does not attempt to mythologize Warren Buffett. What it does in a serious and unpretentious way is to explore the mental structure that shaped his Monument A system of thinking that is quiet, not sensational, but sharp enough to survive every economic cycle, flexible enough to evolve without losing its roots. You won't find get-rich-quick schemes or formulaic investment advice here. Instead, you will meet a human being who lives, thinks, makes mistakes, and learns. With a quiet consistency rare in the financial world. Is it possible to recreate such a mindset, or only people like Buffett? What special combination of instinct, discipline, and humility is needed to live like that? Go in with an open mind and healthy skepticism. Because this journey is not about becoming the richest person, but about becoming the person who understands best what he is doing with his life and with the money he earns. Before going into the book summary, we encourage listeners to buy and read it to fully appreciate the book's content. Now let's get started. Summary of this book. Oma Rask. On August 30, 1930, Warren Buffett was born into a world in decline. Just 8 months later, the stock market crashed. And so this boy entered the world with the shadow of the Great Depression hanging over every house, every conversation, every morning newspaper. His father was a stockbroker, a profession that was nearly wiped out in that fateful moment. When banks collapsed like sandcastles, the Buffett family not only did not surrender but also quietly transformed itself to survive. Warren grew up in a family with strong Christian beliefs, hard work, and an iron grip on finances. But what made him different from the start wasn't morality, but a passion for numbers, especially numbers that can generate money. While his peers were busy rolling around in the grass, Warren was absorbed in the sophisticated game of profit. He knew the prices of every brand of chewing gum by heart, calculated the cost of each bottle of Coke, and even began to think about owning a vending machine. There is a simple yet memorable story about Warren's childhood. He went around the neighborhood selling chewing gum to his neighbors. But it's not what you sell that matters, it's how much profit you make from each candy bar and adjusting your strategy block by block. For Warren, money is not something intangible or abstract. It is a math problem. And like any problem, it can be solved if you observe, think, and persevere. During those early years, Warren began to demonstrate a rare ability to absorb knowledge and translate it into practical business. When he was 8 years old, he borrowed the book 1,000 Ways to Make $1,000 from the public library. The thing is, he didn't read it like a curious child. He read like a strategist, taking notes, analyzing, and selecting patterns that could be applied in Omaha. A child can sit and ponder land investment methods while his friends are playing soccer. It is not a coincidence, it is the seed of a different mindset. Warren Buffett's father was more influential than many realize, a staunch conservative Republican. Howe was both a stockbroker and a member of Congress. While not a legendary investor, he instilled in Warren an uncompromising integrity. This would later become the solid ethical foundation for an entire financial empire. Warren admires his father. But without copying him, he inherited his independent thinking. And as Warren himself later said, "My father gave me the greatest gift of all, the belief that I could make my own way." One of Warren's early turning points came when he discovered the stock exchange. At 11, he bought his first stock, 3C Service Prefs, and his sister Doris. He bought it at $38 a share and then the price plummeted to $27. He panicked but held on. Then the price recovered to $40, he immediately sold it, taking a profit of only $5. But a few days later, the price continued to climb to $200. This feeling of disappointment was deeply engraved in Warren's mind and became an unforgettable lesson. Patience is a vital element in investing. In the innocent view of a young boy, the market is a strange creature, sometimes crazy, sometimes generous, but always a place full of temptation and risk. Warren was not fascinated by that chaos. He was obsessed with the logic behind the numbers. Numbers. What makes the market understandable, measurable, and, if you're smart enough, winnable. As a teenager, Warren didn't play sports or dream of being an astronaut. He read financial newspapers, tracked stock prices, and collected old pinball machines to put in barbershops when he had money. He bought more machines, expanded his network. Just like any entrepreneur like Warren Buffett would do, no one taught him how to do it. He tinkered, assembled his own, and watched every penny go into his pocket. A feeling that, he says, was more exciting than winning a game. For Warren, money wasn't just a destination, it was a sign that he understood the world correctly. If the pinball machine brought in money, it meant he had read the right need, at the right time, in the right place. He learned that success didn't come from luck, but from understanding people. And human behavior was often predictable. If you really looked deep enough. When your peers dreamed of adventures, whether he was a distant traveler or a football fan, Warren found his passion in financial reports and yearbooks. He didn't just read for company names or stock prices, he looked for hidden information, profits, debt ratios, cash flows, and profitability. He understood that behind every number was a story, and if you read carefully, you could see what most of the world couldn't see. That's when you found opportunities. A classmate recounted that Warren could recite the prices of hundreds of stocks by heart, but it wasn't mechanical memory, it was his habit of living with the market. Every morning, before going to school, Warren woke up early to read financial newspapers, write down stock prices in a notebook, and compare their movements over time. No one forced him to do it. It was simply something that made him feel like he was in control of the world. Warren's financial acumen extended beyond investing. He once bought an old camera and took pictures for his classmates, making a profit from each picture. He also sold stamps, even renting out parking lots on the day of a big game. He didn't dream of getting rich. He operated everything as if he were building a business and always knew how to measure its performance. There was a brief period when Warren doubted himself. While most of his friends were preparing for college, he wasn't sure if the academic path was for him. He applied to Harvard but was rejected. Instead of despairing, he chose to study at Columbia University, where Benjamin Graham, who would become the most influential teacher in his life, was teaching. It was a fateful detour that opened the door, Warren himself later admitted. Without Graham, there would be no Buffett. Benjamin Graham didn't teach investing as a way to get rich quick. He taught thinking. He taught that the market can be stupid. But if you have discipline and reason, you will never have to be a slave to your emotions. The view is that price is what you pay. Value is what you get. Graham's writings became Warren's guiding light for the rest of his life. Columbia. Warren was like a fish to water. He absorbed each concept in the book Intelligent Investor as if it were written for him. He understood that investing was not a game of guessing wealth but a form of logical thinking in a chaotic environment. And whoever could keep his cool in a panicked crowd would win. After graduating, Warren returned to Omaha with a clear goal, to become a full-time investor. But things did not go as smoothly as he had expected. No one wanted to give money to a young man who was only passionate about a few lessons from Graham. But Warren did not give up. He started investing with the little capital he had. He opened a partnership with a few family members and friends. What was remarkable was how Warren convinced them. He did not promise wealth, he did not paint a rosy picture. He said bluntly, I will invest as if I were using my own money. I will share fairly. And if I fail, I will suffer more than anyone. It was this way of thinking as a partner and not a broker that made the first people put their trust in fake Buff and never regret it. During the early years of the partnership, Warren maintained a simple lifestyle, no luxury cars, no mansions, no parties. You read books, you analyze businesses, and you patiently wait for real opportunities. Something most of the financial world didn't know to expect from Warren. Opportunity doesn't come every day, but when it does it plays like the perfect chord. The stock price is clearly below its true value. The business has a clear competitive advantage. Leadership with integrity and vision. What's special is that during this period Warren was not just an investor, he was an observer of people. You notice how the CEO talks in the annual report. He heard how they avoided the truth, how they flattered themselves, how they blamed external circumstances. And from those signals, Warren can classify which are worthy leaders and which are braggarts. That sharpness cannot be learned from school. It comes from looking at people as if they were reading a financial report with the same level of alertness and skepticism that is necessary. The first successes came as a whisper, no halo, no accolades, just steady, small but sure profits that began to accumulate for most young investors. This can easily lead to misunderstanding. But for Warren, it wasn't magic, it was simply the logical result of careful observation, sober analysis, and absolute discipline. Each stock you choose is like a seed planted in proven, good, clean, fertile soil. There was a small but very meaningful story at that time. Warren once invested in a small textile company called SBM Company. Most people ignore it because business is in decline. But when Warren read the balance sheet, he discovered that the company had a large amount of bonds worth more than its stock price on the market. In other words, you buy a stock but get an intangible asset that is irrationally undervalued. It is a classic form of investment according to Graham's philosophy. Buy $1 for 50 cents, but what's remarkable is how Warren acted. He didn't just sit back and wait for the stock to rise, he wrote letters to the board, pushing for changes within the company to highlight the true value of the neglected asset. That's a clear sign that Warren is not a buyer. Stay passive. He's an activist, but not the rowdy Go Street kind. He works quietly and efficiently. And always maintain the necessary courtesy. During the time the partnership was growing, Warren introduced operating rules that were very unusual compared to financial industry standards. He refused to raise capital in droves, refused to answer the press, and especially refused to follow trends. As tech stocks began to soar, many young investors were caught up in the FOMO vortex. But Warren was adamant, if I don't understand the business, I won't put money into it. Even though it's been on a meteoric rise, that simple philosophy has been the foundation that has helped Warren avoid countless market disasters. But that doesn't mean he never makes mistakes. He once invested in a business that he later admitted was a stupid mistake. He recounted without defense or excuse. For Warren, mistakes are not something to be hidden, they are something to be remembered deeply, so as not to repeat them again. It is this transparency that has helped his partners gain more and more trust. Not because they think you're perfect, but because they see something in you that's rare in the city. Honesty, without drama. The biggest difference between Warren and the rest of the investing world lies here. You never think you are beating the market. You think you are learning about the business, the market. In your eyes is just a temporary place of valuation, full of emotions, full of distortion. But a business, if well run, can weather any turmoil. That's why, Warren often says, when you own a piece of a good business, you should be happy when the market undervalues it. Because then you can buy more for cheap, an ideal extract that seems paradoxical, but has extraordinary power. The more you believe in your values, the less you are swayed by the emotions of the crowd. And that is what has helped Warren not only survive but also thrive through the most turbulent periods in American economic history. It was also during this period that Warren met and worked with an intellectual friend. The person who would later become the greatest partner in his life. Chairman. If Warren is a stickler for Graham's method of finding hidden value in ruins, Munger is an extension of that thinking. He offers a new perspective. Instead of looking for the cheapest company, find the best company and keep it for a long time. Not a contradiction but a compliment, and Warren took to it like a humble student. Even though he was very successful at that time. The meeting with Munger was a pivotal moment in Warren's intellectual journey. From a classic value investor, he started to become a thinking capitalist. People look not only at the numbers but also at the quality of the people running the business model and the long-term profitability. It's no longer about buying and selling stocks. It is about understanding and accompanying businesses. The change in investment thinking came not from shocks but from long, endless conversations between Warren and Charlie. They don't talk about markets, they don't talk about stock prices, they talk about philosophy, they talk about mathematics, they talk about behavioral psychology. Anything that helps people make better decisions. That sounds far from Go Street. But it is actually that multidisciplinary understanding that is the most sustainable competitive advantage the two of them possess. If you only look at the price tag, you will always be reactive. But if you understand the psychology behind it, you can see it even before the price starts to change. Also during the time partnership was growing, Ren met Sushi. The woman who would become his wife and also his lifelong spiritual companion. Suji is not an investor. But she had an uncanny sense of people and a heart that always understood that Warren needed quiet, needed space to think, to read, to ponder. If Warren is the brain, then Suji is the breath that keeps his inner life balanced, soft, and humane enough. As the partnership's assets grew rapidly, Warren began to experience internal conflict. He felt like he was so successful, but that success was slowly pulling him away from what he loved most. Investing is a mind game. The more money you put into a partnership, the harder it is to find truly undervalued opportunities. The market started to notice the name Warren Buffett and that made him uncomfortable. In 1969, in a move that shocked the financial world, Warren Buffett dissolved partnership. With profits still skyrocketing, most in the industry could not understand the decision. But for Warren, it makes perfect sense. When you no longer find investment opportunities that fit your ethical and moral standards, you should stop not because the market is wrong but because you no longer find harmony with it. This is not just a financial decision, it is a statement. I don't play other people's games. After dissolving the partnership, Warren transferred all of his capital and that of several close partners into a company with a very strange name. Highway. It started out as a dyeing textile company. But to Warren, Bear is not a textile company. It's an empty shell that can be restructured into an investment empire, where you can buy really good businesses and hold them forever. No pressure from World Street and from here. A whole new journey begins. The CAF is more than just a company, it is a symbol of an independent mindset, a place where every decision is made from reason, not the rush to make a profit. There, Warren could apply all the principles he had learned from Graham, Mayer, from life, from failure, from success, and especially from his own moral intuition. Warren once said, "The best way to judge a decision is not whether it is legal, but whether I want to see it on the front page of the newspaper tomorrow." That is not the way of thinking of a speculator because my wife, my friends, my neighbors read it. That is not the way of thinking of a speculator. That is the way of thinking of a person who lives with morality, with identity, and that is the same spirit. The spirit of not being dominated by the noise of the market has turned Warren Buffett from a candy boy in Omaha into a model of the intellectual world of capitalism. If you think independently, observe carefully, and always maintain your humanity in the midst of chaos, you will never have to follow the crowd. To understand why Warren Buffett has become the world's icon of investment intelligence, we cannot just look at the profit numbers, we need to go back. Going into the world, the people have shaped his thinking. Individuals not only sow seeds but also inspire each other in their own unique and fierce way. And in that world, the first person is his father Warren Buffett. Howe was not a famous investor. He was a stockbroker, a congressman and above all, a strong man with personal ideals. He was not swayed by public opinion, did not compromise with the profiteering lifestyle that gradually covered the financial world. In an era where many people could sell their ethics for profit, Ward held on to principles so tightly that he was almost lonely. That imprinted in Warren's young soul that there were things more important than money, and if he could not keep his principles, even if he earned the whole world, he would lose himself. In the early years of observing his father work, Warren learned many things but especially a rare quality, courage in silence. Howe did not shout, did not overreact to the market. He read quietly, wrote quietly, invested quietly. He did not need to be recognized, just knew that he was on the right track. And the son kept that like a seed waiting to sprout. When he grew up, Warren began to seek knowledge outside the family framework. And that's when he met Benjamin Graham. Graham was a special phenomenon. He was a university professor, a legendary investor and the first person to try to turn investing into a science. He was not superstitious about the market, he dissected it, he did not follow emotions. He tested his investment philosophy hypothesis in secure analysis and intelligent investor like a lamp illuminating many generations. Including Warren. Warren came to Graham like a pilgrim meeting a master. But what fascinated him was not the formula or index but the independent spirit, the courage to go against the crowd and especially the metaphorical image of Mr. Market Mr. Graham once drew. Graham said, "Imagine every day a man named Mr. Market knocked on your door, offering to buy your shares or sell you his part. Today he is happy the price is high, tomorrow he is sad the price is low. But don't let his emotions get to you. It is not your responsibility to please him. You only have to make a decision when he offers you a price so unreasonable that you can't refuse. Leave him alone." That metaphor. It sounds naive, but it is at the heart of modern investment philosophy. The market is crazy. It's not a god, you don't need to follow it, you need to observe it, learn from it. But don't let it control you. In Graham's class, Warren is like a thirsty man meeting a fountain. He took notes, pondered over every detail, and began to realize that investing wasn't a guessing game, it was a form of quantitative thinking. If you are sober and patient enough, the feeling is so strong that it lasts even after graduation. Warren didn't want to leave. He wrote a letter of application to Graham Newman, Graham's company, with an incredibly sincere offer. "I am willing to work for free." Graham refused. But Warren did not give up. He wrote another letter. By the third time, Graham was convinced. And that's how Warren got into professional investing. Without an interview. At Graham Newman, Warren not only learned a trade, he observed how Graham evaluated businesses, how he decided to invest, and most of all, how he never let emotions override logic. It is a discipline of iron but not dry. It reminds more of a dead sage than a stockbroker. Graham believed that stocks were only a temporary expression of business value. You shouldn't buy stocks, you should buy businesses or at least buy a part of them. You have to understand how it works. Who runs it, what is its competitive advantage and what is its long-term outlook. If everything makes sense and the price is attractive enough, you buy. Regardless of what the market thought, Warren took that principle as a matter of faith, but Warren was not just a good student, he was the type of student who would dig one level deeper after the whole class had moved on to the next lesson. This sometimes surprised even Mr. Graham. Warren began to develop the sense that while the value investing philosophy was a reliable guide, the real world was more complicated than formulas. There are businesses that are not only cheap but also great. And for such businesses, the real value lies not in the balance sheet but in the ability to generate sustainable profits in the future. Meanwhile, another character appears. Charlie meets Mo just like Warren accidentally meets another version of himself. But broadened by a multidisciplinary vision, Munger is not satisfied with just understanding finance. He reads philosophy, behavioral psychology, evolutionary biology, mathematical probability. For Mayer, understanding the world is not about taking a photograph but about combining dozens of different lenses to create a stereoscopic map. And he passed that on to Warren. The combination of Graham and Munger created a buzz in Warren's head. On the one hand, he retains the basic principles of buying below value, patience, discipline. On the other hand, he expanded the scope of thinking to evaluate businesses not only based on low price but also on quality, profitability, and brand strength. He started looking at companies like Coca-Cola and the Lead Express, names that weren't cheap by Graham's standards but had almost irreplaceable power in the consumer's mind. From here, Warren's investment philosophy shifted from buying cheap assets to buying wonderful businesses at fair prices. This shift seems small, but it is an inner revolution. It required Warren to overcome prejudices, to question his enlightened teacher, and to learn to recognize value not just in numbers but with deep business intuition. What is amazing is that he did it without betraying the original thinking but only making it more refined. Besides, Warren also learned from Mo something very difficult to teach: mistaken view as an asset. They often talk for hours about bad investment decisions, not to blame but to dissect the flawed structure. They call it reflective psychology, the ability to self-reflect and catch one's own mistakes before the world can criticize. This is the important catalyst that keeps Warren's investment philosophy alive, always learning, always innovating without losing the core. In a world where pressure to be right is high, Warren often speaks publicly about the times he's wrong. He says this not to justify but to teach that maturity in investing comes not from glorious victories but from what you learn from each stumble. But perhaps the most unique aspect of the investment philosophy that Warren gradually developed was the relationship between ethics and profits for him. Investing is not a mindless money-making game, it is an ethical act where you choose to put your trust in people who do real things, think real things and run businesses responsibly. He once said, "I would never invest in a company whose founder I couldn't trust to take care of my grandchildren." This is not naivety. This is a value reference system, where trust is not a luxury but the foundation for sustainable profits. If you choose the right person, you don't need to monitor the price list every day. You just need to sit back patiently and let time do the rest. And indeed, time becomes Warren Buffett's most loyal ally for an investment philosophy to last for decades. It cannot be based on financial logic alone. It must be built from a living vision that helps you make decisions even when information is unclear. The market panicked and people's confidence was shaken. For Warren, that philosophy comes from three pillars. Understand human nature, understand business, and understand yourself. Understanding people is fundamental because every business, every stock, is ultimately run by people. If you can't trust the executives, all the beautiful data is just an illusion. Warren spends hours reading shareholder letters, listening to CEOs present, not to analyze strategy but to feel their temperament. He looks for humility, honesty, and a desire to build, not consume. When Warren invests in companies like say Candies or Nebraska Fnitomat, he's not just buying a business model, he's buying the soul of the business. The founders are dedicated, unpretentious, not chasing short-term results. He understood that those people would continue to steer the ship through the storm, not changing course because of street rumors. Understanding business is the technical part. This he learned from Graham but expanded greatly through Mayer. Warren no longer looks only at asset class or P/E ratios. He learned how to look at supply chains, competitive advantage, consumer behavior, reinvestment capabilities, and gross margins. He calls this economic mode, learning economics, which helps businesses not be easily caught up by competitors. He often asked if the company could increase its product prices by 10% without losing customers. If the answer is yes, it is a sign of a strong brand. And if that brand is run by ethical, long-term leadership, he's willing to pay a higher price because he believes the value will continue to increase over the next decade. But the most important pillar is understanding yourself. Warren knows he can't understand every industry. He doesn't understand technology, he doesn't understand art, he doesn't understand new models that have no history. And instead of trying to catch up with the world, he chose to stay in the area he understood. He calls it the CLE of competence. He once said, "I don't need to know more than anyone else. I just need not misjudge what I know." This philosophy seems simple but is something that most investors fail to do. They get caught up in the news cycle, get excited by other people's success, and start to overextend their own sphere of knowledge. Warren does not. He guards his knowledge like a gardener, carefully tending it but not overplanting it with unfamiliar plants. If an investment opportunity makes him feel like he has to guess, he passes. And it was that self-limitation that helped him achieve lasting success. Many people think that good investing is knowing what to do, but Warren says that good investing is knowing what not to do. Throughout the development of this philosophy, he constantly examined himself. He reads thousands of reports but invests in only a few. He talks to people smarter than himself. But don't be convinced too easily. He kept a safe distance between belief and action so that there was always time for reflection. And he spent a lot of time not doing but thinking. For Warren, time is a silent but most loyal companion. He once said, "I'm sitting in the shade today because someone planted a tree a long time ago." That applies not only to finance but also to wisdom. Every day, he reads hundreds of pages of reports, biographies, and analysis not to find something new but to deepen what he already knows. His investment philosophy was not born from impulse but from years of quiet, patient, solitary contemplation. It was in that silence that he saw what the noisy market missed, and he realized a paradoxical truth. The less you act, the more likely you are to win. He doesn't need 100 good ideas a year. He only needs 3, as he once said. Imagine you were given 20 punch cards in your life. Each time you invest, you punch 1. After 20 times, you don't get any more. If that were true, you would invest very differently. That image, the punch card, became a symbol of Buffett's extremely selective investment philosophy. Warren believes that this artificial scarcity helps people become more cautious, disciplined, and focused on quality rather than quantity. That is also why he never trades based on news or trends. He only invests when there is a truly rare opportunity, where all factors, price, quality, ethics, and timing converge into one. One of the clearest manifestations of this philosophy is the way he treats stocks not as commodities but as long-term assets. He does not see himself as a speculator but as a companion of the business. When he buys Coca stock, he does not expect it to increase in price immediately. He wants to own a part of the company he believes will continue to print money regularly for the next 50 years. And just like that, he has held Coca for decades, through many ups and downs, unwavering. The way he defines success is also different from the conventional financial world. Many investors brag about annual returns. Warren focuses on how he treats others, how he chooses partners, and how he protects reputation. He believes that reputations take decades to build but only a second to destroy, and so every investment decision must pass an ethical test. A test without numbers, only intuition and character. But that is what makes him different in a world where everyone is chasing the short term. He is the rare contrarian, and he not only survives, he thrives. All of this adds up to a philosophy. Not just an investing philosophy, but a philosophy of life. It is a philosophy that believes that the world can be understood if you take enough time, that people can be predictable if you pay attention. That humility is the foundation of wisdom. That ethics is not an afterthought but a long-term competitive advantage, and that if you live and invest that way, you don't have to be the smartest person, you just have to be the most consistent. The power of an investment mindset has been tested, and proven over decades. And that is what people call Tunman. Value investing is not a static concept. It is like a living organism. Change, adapt, evolve, and Warren Buffett himself is a living proof of that process. From his childhood absorbing the philosophy of Benjamin Graham to the period of accompanying Charlie Munger and finally establishing the Buey empire. He has gone through 3 distinct stages of investment thinking transformation. The first stage is called classic value investing associated with Graham and Dot. This is the period when investors look at businesses as a set of numbers, stock price, book value, P/E, P/B. They look for stocks that are sold cheaper than the real asset value. The last cigarette colors still have a little bit of smoke. The idea is that even though a business is dying, if you buy it cheap enough, you can still make a profit when the market corrects. Buffett was fascinated by this school when he was young. He searched through financial reports, marking businesses with higher current assets market price and buy a lot with the condition that he would not invest without a margin of safety. That set him apart from the crowd, who invested based on rumors or trends. He invested based on data and only data but also accurately. After many years of practice, realizing that this approach had its limits, he said, I found myself digging up bad businesses just because they were cheap. And I began to wonder if I was investing or picking up corpses. The change came when he met Sis Candice. Sis was not a cheap company by Graham's standards, but it was a special business. The product was popular, the brand was strong, the profit margin was high and special. Customers were willing to pay more each year. Buffett was initially hesitant. But after many discussions with Munger, he accepted what seemed to go against Graham's teachings. There are companies that are expensive but worth buying if you plan to hold them for the long term. This is the transition to the second phase of value investing. Evaluating the business as a living entity. In this phase at this point, Buffett stopped looking at a business as a balance sheet. He started looking at its future cash flow, its competitive advantage, its customer loyalty, and its management team's ability to execute. He stopped asking how cheap it was and asked how much money it would make in 10, 20, 30 years. That question requires a completely different mindset. You can't just look at historical data. You have to understand consumer psychology, industry structure, corporate culture. You have to develop a kind of business intuition that isn't in textbooks. A good example is his investment in Coca-Cola. In the late 1980s, Coca-Cola wasn't cheap. But Buffett saw something the market didn't see. This was a global brand that was tied to consumer habits, could raise prices without losing customers, and had a lot of room for growth in emerging markets. He didn't buy Coca-Cola because it was cheap, he bought it because it was a printing machine. Money wrapped in an irreplaceable brand. In this new philosophy, time becomes the greatest ally. Whereas Buffett used to sell when the price reached fair value, he now holds stocks for decades, or never sells. If you're not willing to hold a stock for 10 years, don't hold it for 10 minutes, he says. This shift is not just tactical, it is essential. Instead of being a short-term opportunity hunter, Buffett became a long-term companion of great businesses. He found a manager he trusted. Then he let them operate, while he read, observed, and waited. This second period, while difficult to measure by available formulas, is the period when Buffett generated the greatest profits. The shift from traditional investing to investing in quality businesses did not come from a magical moment of enlightenment. It comes from a long series of keen observations, self-examination and questioning conversations with Charlie Mayer Munger himself gave a simple yet profound example. Think about whether you want to marry a smart, honest, kind woman or you want to marry someone just because she is on sale. That metaphor is funny. But value investing shouldn't be about bargain hunting, exactly. It should be a serious selection process based on sustainable quality. Buffett admitted that without Munger, he would not have stepped out of Graham's shadow. And if I hadn't stepped out, I wouldn't have been able to be myself. And then the next turning point comes to open the third phase of value in the network economy world. During this period, Buffett faced a new reality. The global economy is shifting from physical production to services, from tangible products to intangible assets, from traditional models to network platforms. That poses a big challenge. How to properly value companies whose value lies not in tangible assets but in connectivity, growth, data, and synergy. A normal person might think BFE would refuse to change, but he didn't. He observed, he learned, he waited. And when the time came, he acted. The most typical is the investment in Apple. For years, Buffett stayed away from the tech sector. He once said, "I don't invest in things I don't understand." But at some point, he realized that Apple was more than just a technology company, it was a consumer brand with rare customer loyalty, price control, a tight ecosystem, and massive cash flow. That was when he realized value in the new era could come from things that weren't on Apple's balance sheet. He saw a new gleaning, not of factories or property but of loyalty. An iPhone user will continue to buy AirPass, MacBooks, iCloud subscriptions. That ecosystem locks customers into the value chain and that's what creates higher profit margins than any competitor. He invested tens of billions of dollars and Apple quickly became the largest investment in Bear Highway's portfolio. Importantly, Buffett does not break his investment philosophy. He expanded it. He does not give up on principles, only investing in what he understands. Find a business with a competitive advantage, honest management, sustainable cash flow, and a reasonable price. It's just that he's learning to understand a new world where value is no longer in the factory but in influence. The third phase of the Buffett philosophy is not just an adaptation, it is living proof of a truth. True wisdom is not conservative but humble. A sharp thinker is not one who is always right, but one who is always ready to update the definition of right. Buffett once said, "The more I learn, the more I realize I know nothing." And that's why I have to keep learning. If the first phase is about numbers, the second phase is about business quality, then the third phase is about ecosystem structure. Something that can replicate value beyond traditional limits, and Buffett, instead of avoiding it, has stepped into it with the learning spirit of an Omaha boy in the evolutionary journey of investment philosophy. One thing that hasn't changed is how Buffett always asks fundamental questions before making a decision. He never asked how much he could make from the deal, but asked if he really understood what was going on. It is the subtle distinction between eagerness and understanding, between reflection and awareness. And it's his adherence to that way of thinking that has helped him avoid the myriad short-term investment traps that the world is increasingly addicted to. In a private conversation, when asked why he didn't invest in internet companies during the bong calm era, Buffett replied with a nearly dry sentence. "I don't understand how they make money and I don't see them making much money in the future." He is not against innovation but he is not dazzled by it either. What he needed was a business model that was explainable and predictable. And most importantly, stand the test of time. That spirit of steadfastness but not rigidity is what makes Buffett's investment philosophy stand out from its time. While many investors pursue complex valuation models and run predictive algorithms, Buffett still maintains the habit of writing by hand, reading physical books and relying on fundamentals. He once said that if you need a complex mathematical model to make investment decisions, you are trying to justify something you don't really understand. The simplicity in his thinking does not come from lack of depth but from a rigorous process of distillation, filtration, and selection. For an investment idea to be accepted by the buffet, it must go through many layers of screening, understanding the industry, understanding the product, understanding the operator, understanding the customer, understanding the finance. And finally, understand the risks. If any level appears obscure, he is willing to ignore it. No matter how attractive the potential profits are. In stage 3, the network stage, Buffett also learned something new: data is no substitute for reflection. Today's world is full of data but lacking in perspective. There are millions of spreadsheets run every day. But rarely does anyone stop to ask if I am deluding myself. Buffett always asks. He asked himself. He puts himself in the role of critic, seeking to refute his own ideas before allowing them to exist. That's why. In B's portfolio, the number of stocks is always small but the quality is high. Buffett doesn't play the risk diversification game by buying everything. He is selective and willing to opt in if he believes. When he bought Apple, he bet more than $30 billion on buying Borington, not Santa Fe, a steel company. He spent more than $40 billion, a number that shocked Wall Street. But in both cases, he did not see it as a gamble. He saw it as undeniable logic. Phase 3 is also when Buffett starts sharing more about its thinking, not just with shareholders, but to the world. In letters to Bear shareholders, he did not boast about profits, he told stories. He told why he chose this company, because he trusted the people running it, because he saw how sustainable the business model was. And in doing so, he taught millions of people not only how to invest, but how to think. Perhaps that is the ultimate evolution of an investor who no longer lives to make money but lives to pass on a way of thinking. If there is one word to describe the entire evolutionary journey in Warren Buffett's investment philosophy, it is minimalism. But minimalism here is not superficial simplicity but the stripping away of everything unnecessary to retain the purest core from a young person fascinated by accounting indicators. He became an economic thinker who was able to see through the glitz of the market to find the true nature of business. In a rare interview, when asked about his favorite investment analysis tool, he replied, "I like to ask, if I owned this whole company, would I sleep well at night?" It's a seemingly emotional question, but it's actually a very sharp mental filter. Because if you can't trust that business for its ethics, vision, profitability, and sustainability, then investing even a small part of it is just putting yourself in a toxic relationship. Buffett has always believed that investing is inherently ethical, not because it requires you to be kind, but because it is a form of commitment. When you put money into a business, you become a part of its story. If that business is dishonest, destroys the environment, or deceives consumers, your profits will be poisoned. He doesn't want that. And he believes that in the long run, the market will not accept that either. The third phase, the network age, taught him that real power lies not in technology but in connectivity. Apple succeeds not because they have the most beautiful phones, but because they create a world where users feel they belong. That's a lesson Buffett carries with him when evaluating every company. Does this business have the ability to create an ecosystem not just of products but also of emotions, habits, and loyalty? And if so, that's where value is created, not volatile, not temporary, but sustainable. By watching how businesses like Amazon, Google, Apple build user networks, data and service platforms, Buffett gradually adjusted the way he looked at risk. He used to think that technology was unpredictable, but he began to realize that if you invest not in technology but in human behavior, stability appears. An iPhone user will have a very high probability of staying within the Apple ecosystem. A person who orders from Amazon a few times will find it difficult to return to the traditional supermarket model. A person searching on Google will very rarely change to Bing or Jiho. And if you invest in systems like that, that is, in behavior that has been reinforced into habits, you don't need to understand all the technology, you just need to understand the users. Buffett calls this the unconscious profit machine of the crowd. In recent years, he has also gradually passed this knowledge on to his successors Totcombs and T. Westler. Those he trusted would carry this philosophy further, more refined. And what makes Buffett most satisfied is not the portfolio they choose but the way they think, patient, humble and always start with questions. Do we really understand this? Chapter 3 ends with a profound paradox. In a world of constant change, the most sustainable thing is a mindset that knows how to change without losing its roots. Buffett did it not by following trends but by keeping an internal compass accurate enough to keep him going even when his old map no longer worked. And that is the essence of evolution in value investing, constantly expanding the definition of value but never betraying what created that value in the first place. For most investors, the market is where stocks are traded, where price determines everything. But for Warren Buffett, that's just the tip of the iceberg. What he really looks for, what he really invests in is businesses, not stocks, not codes, not charts, but living, breathing entities with people, culture, history, and a future. Investing according to Buffett is an act of ownership. And once you own it, you need to know exactly what you're holding. If you can't describe a company's business model in a few simple sentences, you don't understand it. And if you don't understand it, you have no reason to put money into it no matter how attractive the stock price is. He calls this investing from the perspective of a business owner. Investing from an owner's perspective. That perspective completely changed the way he analyzed and made decisions. Instead of asking whether this stock price would go up, he asked how this business will operate in the next 10 years. Instead of tracking price movements, he looks at payroll, production costs, expansion strategies, and cash flow management. Instead of being attracted by the cheapness, he was attracted by the business's ability to be sustainable and reinvest profitably. He doesn't buy a piece of the market, he buys a piece of the business. And that's what makes Buffett different. A classic example is an investment in an auto insurance company with a unique business model of selling directly to customers without going through a broker. Most of the market sees this as a risky model because it disrupts the traditional distribution process. But Buffett sees the opposite. Jew eliminates the middleman, saves costs and reaches consumers directly. People increasingly prefer transparency and speed. But more importantly, he looked at the essence of GEICO's culture, a lean management team focused on efficiency, always thinking of the customer first. He doesn't need a complicated pricing model. You need to understand who runs this company, what they think, how they treat their employees, what their ambitions are. Because according to him, people create strategy and strategy creates value. Investing in GEICO is not an impulsive decision. It has been tracked by BF for years. Starting from his early days working for Graham Newman at that time. GEICO was one of Graham's most successful investments, and Buffett spent an entire Saturday knocking on the company's office doors. Meet with employees just to understand what they do, what they think, and why they are different. It was that Saturday that sowed a seed that would bear fruit decades later. It's not news-based investing, it's slow, deep, and patient observation. The kind of investing that Buffett believes in is like getting married. You have to know the other person well before you nod. He applied this philosophy to every major BSA hardware deal, including the purchase of Burlington Northern Santa Fe, the largest railroad in the United States. He doesn't think about the stock price. He thought about the need for domestic freight, the irreplaceability of the rail system, the energy efficiency compared to trucks, and the sustainability of the operating model. People ask why he invests in an industry that seems old. Buffett just smiled, because I understand it and because America will need railroads for a long time. That answer shows exactly how the thinking goes. He does not run after new things to prove himself sharp. He looks for something of lasting value, regardless of the times. He doesn't have to be trendy, he just has to be right. There is a concept that Buffett repeats like a mantra throughout his investing journey. The investment comfort zone, or as he calls it, the sickle of competence. He believed that each person only truly understood a limited number of fields. Outside that circle lies the fog, the illusion of understanding, where risk resides under the glitz of false confidence. So when Buffett invests in a business, he doesn't ask what people are thinking, he asks, do I really understand what's going on? He doesn't look for hot industries or names in the news. He looked for businesses whose operating model he could describe simply. So clear and honest that it can be explained to a 10-year-old. In a private sharing, he told about an interesting rule that he applies every time he researches a new business. He envisioned himself owning 100% of that company, with no stock market, no electronic price board, no one ready to buy it tomorrow. Would you be happy to keep this company for the next 20 years? If the answer is uncertain, he will not invest. That philosophy sounds harsh, but it actually has a very human spirit. It is engaging, responsible, and thoughtful. Because when you own a business as your own boss, you're not going to try to surf it. You will care for it, watch it grow, and be patient when it faces difficulties. That is the essence of business-driven investing. Another prominent example is when he invested in Sis Candice, a candy company from an accounting perspective. It wasn't a glamorous deal, small in scale, local in market, slow in growth, but Buffett and Mung saw something that the financial statements didn't show. Customers are willing to pay more each year for the same box of candy because they are emotionally attached to the brand, not the candy. They buy an experience that is tied to a memory. And this emotional asset, while not recorded on the balance sheet, is what brings in high profit margins in a sustainable way. I understand that strong brands, loyalty, and pricing power are the most valuable assets in business. He invested $25 million to buy the company, and over the next 50 years, Sis returned more than $2 billion in profits to Bear. It all comes from candy, but really it comes from love. Since then, Buffett has become more convinced of one thing. If a business can control its prices and customers are still happy to pay them, that's the business you should keep for life. And he applied that principle to larger deals. Coca-Cola, Express, Durka, FurnitureMart. Each name is a testament to a sustainable value system, where the brand is the castle, customers are loyal residents, and price is a solid defensive weapon. But here's the interesting thing, Buffett never just looks at the product, he looks at the operator. He wanted to know what they think about in the morning, what they base their decisions on. Are they greedy? Do they value long-term value over short-term profits? Because, as he often emphasizes, a great business model in the hands of a mediocre person will still be mediocre. Yet an ordinary model in the hands of a great man can become a legend. When Buffett talks about the people who run the businesses he invests in, he doesn't use the language of Go Street. He didn't care if they had a MEBA degree or worked at McKinsey. He pays attention to how they talk about employees, how they treat competitors, how they react when they make mistakes. He wants to see integrity not on PowerPoint but in action. Even in the smallest act of researching a local insurance company, he didn't look at the payroll or expense report first. He went to the headquarters, talked to the receptionist, and asked, if a mistake happens, do people here blame each other? It's not a financial question, it's a cultural question. And for Buffett, corporate culture is the best predictor of a company's financial future. He understood that in the long run, the market may misprice but ethics never mislead. A company run by someone with vision and integrity will know how to navigate a crisis, how to inspire their team, and when to stop and think. He called that the kind of person I could give the key to a safe to and travel for 10 years without a worry. Buffett's business-based investing philosophy also has another consequence. He doesn't care much about the timing of the purchase. While many people are obsessed with marketing, Buffett is almost indifferent to it. Because if you own a good business, the daily fluctuations in stock price do not change the nature of that company. He said, "I'm happy when a stock goes down because I can buy more. I'm also happy when it goes up because I get confirmation that I'm right. All roads lead to optimism." This is not a carefree attitude. It's the result of a deep belief that investing is not a game of who's faster but a game of who's more patient. And that's why Bear Hardway operates like a fortress. It's not a hedge fund that changes its portfolio every quarter. It's a collection of real businesses, with employees, with factories, with customers, that are being run with the sole goal of creating long-term value. No exit strategy, just anti-discipline. That is, get in right and let time do the rest. But he's not naive, he knows that not all businesses are good forever. So an important part of this philosophy is risk management from the start. Before buying shares in a business, Buffett asks 3 questions. 1. Do I really understand the business? 2. Is the manager honest? 3. Does the company have a sustainable competitive advantage? Only when all 3 questions are answered with a clear yes does he consider the price factor. If a business is good but the management is shady, he passes. If the manager is excellent but the business model can be easily copied, he passes. If everything is good but he doesn't understand how they generate profits, he passes. This discipline doesn't come from excessive caution, it comes from a kind of self-respect in thinking. Buffett doesn't want to invest in something he can't explain to himself. Because if you can't articulate what makes you believe, then that belief is superficial. And for him, investing is a form of commitment. And commitment can't be superficial. It's thanks to that business-based investing philosophy that Highway gradually became a model unlike any other company in the financial world. It's not just a parent company that owns a series of subsidiaries, it is a mental structure. Where each investment reflects a set of values, a deep belief in people, in the quiet operation of ethical principles in business. Look at how Buffett describes his decision-making process. No noisy board meetings, no huge data analysis team, just a few financial reports, a clear head and a lot of time to reflect. He reads everything from shareholder letters to industry histories, from founder biographies to customer reviews. All to answer the simple question, do I want to own this company? And once he decides yes, he invests with completeness as if he will never get out. He does not ask for control, does not interfere with day-to-day management. He just sends a simple letter, keep doing what you have been doing. But now you work for Buxer. That sounds easy, but it is actually the result of a process. The screening process is extremely rigorous. Because once he trusts you, he will not doubt you, and once he doubts you, he will never invest. There is a term that Buffett often uses, pet zone, the ideal investment zone. It is where 3 factors intersect. Easy to understand business. Sustainable competitive advantage and honest executives. Buffett does not need a fast-growing market, does not need a breakthrough idea. He just needs to stand in the right place and wait for time to prove it. How he invested in ISCA. The Israeli cutting tool manufacturer is a classic example. An unflashy industry, a company that no one knows in the US. But there is a classy, creative and ethical leadership team when Buffett met STF, the founder of ISCA. He said, I see in him the shadow of Sam Walton, the founder of Walmart. I need nothing more. He bought the entire ISCA in just a few weeks. No investment bank, no pit deck. After that deal, B earned billions of dollars in profits over many years without a strategy meeting. This story reflects the deep nature of the investment buffet, not seeking perfection but recognizing fit, not chasing the market but building relationships, not investing for indexes but for moral intuition. And so, Barrere became a home for entrepreneurs who did not want to be controlled by Go Street. People who want to be trusted, to be autonomous and to be respected. Buffett understands that good people don't need supervision, they need space to invest if done properly. It's not a game of numbers or charts. It is a profound form of placing trust in people, in businesses, and in timeless values, honesty, patience and ownership in a world where everything can be bought, sold, replaced. Buffett's boost-driven investing philosophy reminds us that there are things worth keeping for life if you find a business like that. Don't sell it just because the market goes up or down. Keep it like you would a good friend, rare, trustworthy and irreplaceable. In the modern financial world, where money moves at the speed of light and news changes every second, there is a simmering battle that has been raging for decades. The battle between active and passive investing, and Warren Buffett, who has beaten the market for more than half a century, is on the side of passive investing. Sounds contradictory, but that is the most interesting paradox in his thinking. Buffett does not deny that there are a few people who can beat the market. He himself is living proof. But what he believes and publicly repeats is that the vast majority of investors, including professional experts, cannot do it in the long run, not because they are stupid but because the system is designed against them. He is the institutional imperative, institutional inertia. Imagine you are a professional fund manager. You are under pressure to beat the market every quarter. You are constantly compared to competitors, you have to answer to shareholders, investment boards, the press. You cannot be wrong. Or if you are wrong, you must be wrong like the rest of the industry. You must be busy or look busy, and you must never say I don't know. In that environment, how can you make long-term, independent, and thoughtful decisions? Buffett believes that this is why proactive management often fails, not because people are incompetent, but because the system rewards compliance, not sharpness. The system prefers someone who can give a convincing PowerPoint presentation over someone who can sit still for 6 months without trading. What is the result? Investment funds change their portfolios constantly. They trade on news, they follow trends. They charge high fees and they create something called unnecessary activity. Buffett once joked that in investing the less you do, the better the results, as long as you are well prepared. But that's hard to do in the professional wealth management environment, where silence is seen as laziness and patience is mistaken for indecision. Therefore, he recommends that most individual investors should choose another solution. Passive investing through low-cost index funds. This is not flippant advice. That's advice from someone who has spent a lifetime analyzing the markets and understands that investment returns come not from activity but from behavior. If you can't stay disciplined, if you get affected by the news, if you panic when the market drops, an index fund can be your most reliable companion. Buffett once bet $1 million that a simple index fund would beat most hedge funds over 10 years, and he won, even in a boring way. Index funds do nothing, just buy the entire market and leave it there. While hedge funds rotate, hedge, time, after 10 years, index funds still win, no glitz, no drama, just the bare facts of math and low costs. But Buffett isn't saying active management is useless, he's just saying it's hard to do well. And only a small group actually do it. People who think independently, are not bound by organizational structure, have extraordinary discipline and have an ability to endure loneliness when making decisions like no other. Those who do, Buffett calls them WHOT for them so. They don't read analytical reports for ideas, they read them to reflect on themselves. They are not forced to make decisions every day. They are willing to let opportunities pass them by if it is not within their scope of understanding. And above all, they don't try to beat the market with speed, but with depth. Buffett has never made it a secret that he admires a handful of truly outstanding activist investors, notably Clement, Greenblood, and especially his close friend Charm. They all have one thing in common. First principles thinking always begins with the question, what do I know and what do I not know? Then build your investment thesis from there as a solid foundation. The problem is that the system doesn't reward this kind of thinking. Most professional investors are pushed into the paradigm of having to look like they are passionate about their work. If you manage a fund that doesn't trade for a year, you'll be considered to have no strategy. Even if your investment results far exceed the market, inactivity is still considered a risk of losing customers. Buffett once commented, "Good investing often looks boring, but the street doesn't sell boredom, and that's where things start to go wrong." Funds have to spend money on marketing, have to hold client conferences, have to maintain a team of analysts, have to come up with new investment views every quarter. But the truth is that value doesn't come from what you think each quarter, but from what you keep right over many years. So Buffett is not surprised that most active funds fail to beat the market over 10, 15, or 20 years. They failed not because they lacked intelligence, but because they were hampered by their own business model. And that's why he chose a different path. YR has no daily customers, no quarterly growth expectations, no constant portfolio changes required. Bear is where Buffett and MR can invest as they want, slowly, surely, without being disturbed by noise from the market. It is in that environment that they can develop a special ability that most active investors do not have. The ability to do nothing. If you look at Boer's portfolio, you'll see something strange: it changes very little. Stocks like Coca-Cola, Express, Ms. are held for decades. Not because they don't have new ideas, but because they understand that once you find a great business, time is your strongest ally, not category optimization. Buffett calls this the art of staying still, the art of stillness. But to be immobile properly, you must have an extremely active mindset. Because you have to constantly examine your beliefs, constantly ask what has changed. Is this business still worth keeping? Am I acting out of logic or emotion? And only when you can answer those questions with absolute honesty do you have the right to do nothing. During a speech at Columbia Business School, where he studied under Ben Graham, Buffett said something that silenced the audience. "You are being taught to take action, but the truth is in investing most of the time the best thing you can do is do nothing." A student asked back somewhat skeptically, "If everyone sits still, who will operate the market?" Buff smiled. "Who cares about the market? When you own a business." That answer is at the heart of Buffett's thinking. He did not see the market as a place to bet but as a trading counter where prices went up and down every day. But smart buyers will only act when the price is too attractive, most of the time. Let the seller talk to himself. This is why he often returns to the metaphor of Mr. Market. Met the legendary character that Ben Graham once portrayed. M is a moody guy today. The pessimist is sometimes willing to sell the business to you for a cheap price and other times wants to buy it back for a crazy price. Your mission is not to be infected by his mentality. You must be the judge, not the judged. Buffett believes that most active investors fail because they start with the wrong question. What is the market doing? What is this business doing instead? They get caught up in short-term fluctuations instead of focusing on long-term business performance. They react to noise instead of reacting to logic. And they act not because they see opportunity but because they fear being left behind. That mentality fairness of missing is the biggest enemy of the active investor. And that is also why Buffett constantly emphasizes that discipline is the deciding factor, not intelligence. He once said, "There are thousands of people smarter than me working in the World Street, but they can't keep their hands in their pockets long enough." The implication is clear. Patience, the seemingly backward virtue, is the sharpest weapon in investing. The story he often tells to illustrate this is about a round rock lying still at the bottom of a lake. You can kick it out, create a little ripple, but then the water will become heavy again. Buffett chose to be that rock. He doesn't care about the sound of the waves, he cares about the nature of the lake. And because of that, he is often underestimated in the short term. There are years when the market is strong, forcing people to stay out. There are times when people call him old-fashioned, conservative, slow. But then over time, the results say the opposite because investing, as he once said, is not a sprint, it is a marathon and sometimes a solo run in the fog. But Buffett doesn't just talk down, he acts exactly as he preaches. He keeps Coca-Cola for nearly 40 years. He doesn't sell Apple when the price has gone up several times. He doesn't change his portfolio just to refresh his report. He lives as if time is his friend, not his enemy. And that's something most active investors can't do. Not because they don't want to, but because they're not allowed to. But this chapter isn't just an indictment of active management. Buffett doesn't oversimplify it that way. He understands that there are still people in the investment industry who operate with faith, intelligence, and ethics. What he points out is that the current system doesn't encourage that, it even punishes it. When you're a fund manager, you have clients, and clients have expectations. Expectations often come from short-term comparative performance. And if you don't outperform for a few quarters in a row, you lose money, you lose your reputation, you lose your job, you have consequences. You have to do what's predictable, measurable, and explainable. Even if that means giving up your independent thinking, Buffett once said coldly, the street can't they pay to be right, they pay to be the same. And this is why he advises investors, individuals, who are not dazzled by the fund model. Take advantage of that freedom to do what the experts cannot with patience, independence and long-term thinking. Investing is a psychological journey rather than a technical one, and those who understand themselves, control their greed and fear, are more likely to win not the market but themselves. Take the example of B Highway itself. It is a public company but operates like a private company. No quarterly press conferences, no profit forecasts, no dividends, no buybacks unless they truly believe it is undervalued. And above all, no apologies for going against the crowd. It is a strange model in the investment world. But Buffett does not care about strangeness. He cares about being right. And right in his view. That means you do not invest to impress, you invest to protect your capital, grow your capital, and preserve your reputation. If that makes you look different, even boring, so much the better. In a letter to shareholders, Buffett once wrote, "We do not aim to be the smartest people in the room. We want to be the most rational people. Rationality is not about doing more, but about doing it right." This chapter therefore ends not with a conclusion, but with encouragement. If you are an individual investor, do not try to imitate the street. You do not need to operate like them. You do not need to report every quarter. You do not need to trade on the news. You just need to understand what you are doing, understand the business you buy, and have enough patience to wait for time to answer. The problem is not that active management does not work. The problem is that most people are not free enough, not disciplined enough, and not brave enough to be truly proactive. And if you are the one who can do that, you do not need the street to win. They call Buffett the Oracle of Omaha, the greatest investor of all time. The only phenomenon of the street go still retains dignity. But all those titles, though accurate, are just static pictures. Freezing a character that is always moving. To understand Warren, who is Buffett really, Robert Hagstrom presents an unexpected image. He is an athlete, not a physical athlete but an intellectual athlete. Who spends his life practicing, improving his mental endurance, concentration and accuracy in decision-making reflexes in any top sport. There are three key factors: technique, physical strength and competitive psychology. With investing Buffett, the same is true. Technique is about understanding the business, knowing how to read financial reports, understanding cash flow. Physical strength in the mental sense is the ability to withstand pressure, loneliness and mistakes. And that competitive psychology is where you show your mettle when the market is spinning, when you are criticized, when everyone else has run to the opposite side. Buffett has never waved victory, nor does he consider himself a genius. He is a person who has practiced for decades, read thousands of reports, pondered hundreds of industries, and constantly criticized himself. He does not look for a winning shot, he looks for a sure shot, where the probability of success high enough that he doesn't need to risk his life. And like any great athlete, Buffett has a strict set of rules. He knows his turf, the industries he understands. He doesn't play without warming up, which means he doesn't invest without understanding the business. And especially he doesn't get caught up in the audience's rhythm, which means he doesn't let market emotions change the way he plays. But Buffett isn't just an athlete, he's also a teacher, and that's probably his favorite role. Look at the way he writes shareholder letters. They're not administrative documents, they're lectures, concise, honest, and rich in imagery. He teaches compound interest like a storyteller. He teaches business ethics like a father teaching his children. He teaches failure like a person who has just fallen and stood up. Every year, millions of people who don't own say stocks still read his letters not to get rich but to learn how to think. Buffett believes that the right mindset is more important than a good idea, and the right mindset only comes when you constantly listen, learn and be willing to question even the things you once believed. He does not stand on a podium. He does not shout into a microphone, he teaches through consistency between words and behavior, between principles and actions. He teaches through his own life. That is why many people from high school students to top CEOs consider him a spiritual mentor even though they have never met him. They learn how he chooses partners, they learn how he admits mistakes. They learn how he faces success without arrogance, faces failure without excuses. And perhaps most surprisingly, he teaches investing without talking much about money. Because for Buffett, money is not the goal. It is just the result of a process of thinking right, living right and doing right. He does not collect airplanes, does not build castles. He lives in an old house, drives an old car, drinks Coke, eats burgers. The only thing he invests in is luxury books and reading time. At this point, we can ask if Buffett is an athlete and a teacher, so what is the third side of his money? HCK calm answers. He is an artist. An artist. In the midst of Go Street, full of mathematical and logical nuances. This word sounds like a misnomer. But look at how Buffett makes decisions not by formula but by feeling. Notice how he talks about a business he loves, like Coca-Cola, like Siskandy's, in emotional language. That is a company I want to keep forever. He doesn't calculate those amounts in an Excel spreadsheet. He feels them. Buffett is an artist because he creates within a framework. He knows the rules, understands the limits, but constantly finds unexpected combinations of seemingly disparate elements. He looks at a business model and combines it with behavioral psychology, with ethics, with economic history. As if a painter is mixing colors to create a new school of painting. And like all great artists, Buffett doesn't follow the latest trends. He doesn't paint to order, he doesn't need to be released. He paints for himself, for clarity, for the joy of creating, and for the feeling that he has expressed something true about the world. As a result, his investment decisions always have a strong personal touch. He didn't buy Apple because it was a technology company. He bought it because he saw it as a money-making machine, emotionally engaging with users, and able to lock customers into an experience that very few companies can do. He didn't buy Bington nor Sun because it was transportation. He bought it because he believed in the sustainability of the rail network and its ability to change the flow of goods in America. In other words, he didn't just analyze, he felt. Hsom argued that a person who only followed techniques would become a machine, a person who only taught what was known would become dogmatic. Like the artist, the person who stopped to listen, to doubt, to feel the world with intuition and faith is always evolving, and over the decades, Buffett has been evolving like that. So, Monument is not a rigid structure, it is a flow. In it, the athlete gives us endurance, the teacher gives us thinking, and the artist gives us depth. These three models are not contradictory but complementary, like three pillars of a bridge spanning the river of doubt when Fitu and Br Hall. It was a dying textile mill, a bad financial decision, but he turned it into an investment platform, a blank canvas. And then over decades, he painted a picture of a business with all shades. From sweet cis candies to whining BNF. From modern Apple to traditional money. It was all in that picture. Where he was the only painter who didn't need a brush, just the right thought. But to maintain an artist's mind in the cold world of finance, you have to have something that very few people really possess. Self-confidence. Not the kind of ostentatious confidence, but an inner peace. That can only come from knowing your limits, knowing values, and is willing to live by them no matter what happens around him. Warren Buffett does not live in an isolated cocoon. He does not avoid the market, does not reject technology, does not deliberately appear classical, but he never lets himself be dragged by the rhythm of the crowd. And that gives him a spiritual freedom that many other investors can never buy. Hagstrom emphasizes the combination of pedagogical sports. Art in Buffett's thinking is not a strategy, it is a personality structure. He does not choose them to beat the market. He lives like that, thinks like that, and invests as a natural part of that being. That is what creates sustainability, because no one can copy an individual without copying that person's soul. And then there is a deeper meaning in the concept of Mayans, which is the relationship between money and existence. Buffett once said, "Money is just a tool. It helps you do many things, but it does not say who you are." Many people think he is humble because he is rich but lives simply. They do not understand. Living simply is not a PA strategy, it is liberation. When you are not controlled by the desire to possess, you can think clearly. Make cold decisions without losing humanity. Buffett can buy everything, but he chooses to buy time to read books, time with people he trusts, time to think. That is true wealth. Hagstrom poses a counter-question. If he lost all his money, would Buffett still be a monument? The answer is yes. Because what makes Buffett is not the assets he owns, but the way he sees the world, the way he makes decisions, the way he keeps himself from being swept away by emotional waves, the way he keeps the basics unchanged even though everything around him is constantly changing. And that is a rare quality, because most rich people, although they start with intuition and principles, over time they become complacent or too cautious. They start to protect their assets instead of looking for opportunities. They invest to defense instead of growth. But the difference is different. He is still excited about each new shareholder letter, still reads corporate reports like a child reading comic books. He has never lost his curiosity. Even at 80, the artist in Buffett has never faked. In the last years of his career, Buffett does not talk much about investment strategy anymore. He talks about people, he talks about personality, about reputation, about choosing companions. In a talk with students, when asked how to become a millionaire like him, he did not mention stocks or yields. He said, "Find people you admire and then live in a way that makes them admire you." That answer not only silenced the crowd, it made them look back. Because in today's world, where data is the crown and efficiency is deified. A moral advice that seems silly, but that is the paradox that makes Buffett. The further he goes in his career, the more he returns to the most basic things, the middle, honest, humble. Kindly Hagstrom writes that if you want to learn Buffett to get rich, you will learn wrong. But if you learn Buffett to become a better person, you will naturally become rich, not only in money but in the life you live. Money in the final definition is not a profit-making machine. It is a mind that understands the role of money in life. It does not deify money, nor does it despise it. It puts money in its right place. A tool, nothing more, nothing less. And like any tool, it is only valuable when used by someone who knows what he is doing. Buffett is such a person. He is not a symbol of wealth, but a symbol of clarity. He is not a market winner, but a person who refuses to let the market define him. He does not live to make money, but uses money to live the way he believes is right. And that is perhaps the ultimate definition of a monim. You may never have invested a penny in stocks. But if you learn how to, if you think about risk, about time, about people, you will own an asset more valuable than any investment portfolio. A mindset worth living. Thank you. Not only for listening to this book to the end, but for taking the time to ponder with me. Because Warren Buffett does not need another fan, but this world always needs another person who knows how to think clearly, knows how to invest in important things, knows how to live slowly and courageously. In an era rushing towards turbulence, we have just gone through not only investment strategies but also delicate slices of a system of thinking, where my morning is not simply a profitable brain but a mind that knows how to put money in the right place, both literally and figuratively. A mind that respects time, understands the power of silence and never trades principles just because the market is screaming. If this book leaves you with an indescribable feeling, a wavering between reason and morality, between strategy and humanity, then that is what I hope. Most awaited. Because the difficulty in naming it is a sign that you are entering a realm of intelligence that is not easily expressed by charts or formulas but must be felt through the depth of real life. I hope you will not only study Buffett but also try to live somewhat like him, be calmer in the face of excitement, more skeptical of things that are widely praised and more sincere with things that seem small. If you find this journey meaningful, please leave a review or comment, not for me to be praised but to let the community of people who read and think together know that this is a place worth stopping, listening, and pondering. Your review is a form of precious capital not for the market but for those who seek something profound. And if you have another book that you think is worth telling, to read together, to explore as we just did, do not hesitate to suggest it to me. I am always looking forward to a new door, a new perspective, a quiet voice that is being forgotten in the noisy crowd. Because just as Buffett once said, good investing is about transferring money from the impatient to the patient, and good storytelling is about transferring thinking from the indifferent to the courageous enough to care deeply. And I believe you are one of them. Thank you, see you in another book.